I want to turn to a different topic, Simeon, that ProShares is very involved in, and that is, and I get questions on this all the time. These incredible volumes in the ProShares long and short Nasdaq 100 and S&P 500 ETFs. It's an amazing business that you've got going here. Every day, I look at the heaviest volume ETFs by dollar value and just sheer volume, and these show up every time. ProShares Ultra Pro QQQ, here we're listing them here. This is 3 times leverage, the first one, and the Ultra Pro Short QQQ, the ProShares Ultra Pro Short QQQ. So these are amazing. The Ultra Short Pro QQQ is 3 times inverse. Ultra Short QQQ QID, they don't have the symbols here, it's 2 times the inverse. The Short S&P, which is SH, is just a simple inverse. Every day, they have the biggest volumes here. And we've talked often about these leverage and inverse products, how they reset every day, how retail investors should be careful. Can you tell us a little bit, who's using these products exactly? I mean, the volume is so titanic that I want to see a use case for this. We tell retail investors probably shouldn't do this and hold them for long periods of time, but somebody's trading these things like crazy.
Well, there are a range of uses. We always talk about this. We're super proud to offer the toolkit to investors, both sides of the trade, depending on your point of view. I think when you look at a volatile market like this, one of the things that I'm sure that you notice is the divergence of views. This is a time when there's some people who think this is, they see the CPI print and they think that's only the beginning of the bull run, and then there's some other folks that say, man, I'm gonna sell this after this rally. So I think that divergence of views prompts folks to use these tools at a little more volume. And even in this environment, there are uses that are particular to right now and this time of year. As an example, tax loss harvesting. What if I'm about to harvest some losses on my high-flying tech fund? Well, I go harvest the losses. I can use a ProShares long QQQQ, and I can have my exposure to the end of the year and figure things out later.
Maybe, yeah. I guess you know what I would like to do? I'd like to bring some big active traders on and show how they use this, because there's got to be some relationship between, say, owning a sector like the Nasdaq 100, owning options and having different positions. There's a clear trading vehicle that's possible here, and I would like to see a clear use case, because the volume is so big that this isn't just a bunch of retail people, suddenly deciding they want to own GameStop on a day when GameStop's up 3%. This is very systematic, and there's some kind of trading methodology that exists, and I understand why some people don't want to tell us about it, but it's very obvious.
But also simply the fact that we forget the democratization is important, but also the fact that it's efficient. Even folks who could replicate that using the underlying instruments can often find our vehicles to be very efficient, and of course they trade all day long in tight spreads, so that makes it efficient for a wide range of folks.
I try to get this out of him every time I bring him on, and he always just talks to me about the diversity of people using the place. Okay, so we have often talked about, I call it the increased complexification of the ETF structure. I'm a Jack Bogle guy. I loved ETFs because indexing, it made indexing possible for the masses. Indexing was the important thing that came first, that understanding back in the 70s, and then in the early 90s we started getting a way to get those indexes through ETFs. So that's why I like ETFs. Lower cost, tax benefits, just better for the average investor. But things have been getting increasingly complex. As the industry has matured, they're looking for other sources of revenue. So ProShares has been the leader in leverage and inverse ETFs. You can argue, do I need 3 times leveraged S&P or triple Qs? Does the world really need that? Well, he's made a pretty good business out of doing that. Does the world really need 3 times leveraged oil funds? I don't think so, but there are people who think they can make a business out of it. I don't know. Should we prevent that from happening? What would be the criteria if it was some kind of threat to the system, for example, if it was a systemic threat? I don't know. Is there a standard that we should use about complexification of ETFs? And single stock ETFs, another example.
I mean, it's a great question. So FINRA did a consultation back in May to figure out how they should look at complex products. They want to think about how they should be defined. Should there be sales practices? Should investors have to attest to understanding the product before they buy? Should they have to have a certain level of assets? So right now, that consultation is ongoing. I heard the head of FINRA speak recently, and he said likely if they were going to move forward and do something, they would not specify exactly what they are, but there would be probably 3 more consultations before something was passed. So I think it is an ongoing issue that many of the regulators want to define this.
What complexification is.
Well, what a complex product is.
Should we separate, say, leverage and inverse products from regular ETFs into a different product category?
Yeah, many think that should happen. I mean, in Hong Kong, they are different, so they don't call them ETFs, they call them LNI products. So regulators around the world have different views on many types of products.
How would you feel about that? Should there be a different asset class? Is it not an asset class? Should it be a different category? Yeah.
We're a disclosure-based system. You know, there are lots of things and lots of ETFs and mutual funds. We were just talking about bond ETFs. Many of them use derivatives to get their positions. So, you know, disclosure is an important way to go.
There's another standard Simeon line that I keep getting. Despite stock, I love him. He stares at me. We get the same answer. Despite stocks down 20% this year, let me turn to you as our ETF expert. And bonds are down. The U.S. ETF industry, folks, you know this. It keeps raking in assets. It never loses. We have 3,000 ETFs now in the United States. 3,000. Right. We have assets of $6.3 trillion. This is Deborah's numbers, by the way. And we have 266 providers. You know how I know that? Because they all write to me. Stop writing to me, please. It's remarkable. Now, it's not just mutual funds converting to ETFs. We still see that happening, but it still comes in.
Well, I think there was an interesting study that Charles Schwab did where they said that 15% of investors in the stock market a year ago were new investors. So you're seeing new people come into the market. I think many because of your show, right? During the pandemic, most people were watching CNBC. Yeah. What's going up or down? And you were showing ETFs, right? People became familiar with them, were putting money into them. I think the other driver is as people get close to retirement, and about 10,000 people do that every day in the US, they look at how they should be investing going forward. They go to robos. They usually don't put their money into the robo, but they use that to become familiar with ETFs, asset allocation, low cost. Then they call an advisor and invest money, typically in ETFs. So I think there's a number of drivers, but the biggest driver has been institutions using ETFs. If you look around the world, many countries will tell their pension funds, when you want exposure outside of our own country, Mexico, Chile, Peru, Brazil, invest in ETFs because they're low cost, easy to use, easy to get in and out of, and that's been a real driver for assets globally.
I've seen that, Simeon, with the RIA business. You know, I go to these conferences, and you've got a lot of guys who are quitting Morgan Stanley and setting up their own shop, and they want to find the most efficient way to set up shop and keep the costs as low as possible. If you want to get below 100 basis points on a client, that's not easy to do, but you can theoretically pull that in, and there's a lot of RIAs, they want 100 basis points. They want to charge. They don't want to charge 200 basis points, and they use ETFs. So the structure makes complete sense to me, and I'm not surprised that this keeps happening.
No, if you go back, 10 or 15 years, and you were talking to an RIA, financial advisor, and you'd ask the question, "Are you using ETFs?" We don't ask that question anymore. It's not a question. Everybody has converted their book to, if not entirely, but directionally towards ETF.
Let me ask you about your biggest asset, or your single biggest holding, which is Noble, the S&P, NOBL is the symbol, folks, which is the S&P Dividend Aristocrats Index, I guess you would call it. This tracks a basket of companies that are increasing their dividend year after year. Why is this the best strategy to own dividends and not just let's buy something that has the highest dividend yielding companies?
It's an elegant strategy because all you got to do is look for the companies that have consistently grown their dividends, and Noble tracks the S&P 500 Dividend Aristocrats. That's 25 years in a row. And I'll give you 2 reasons. One, because the dividends grow, which sounds tautological, but that's the key. It is the quintessential inflation hedge. Those dividends have been growing 12 to 14% a year since the inception of that index. Number 2 is the high quality. If you look at Q3 earnings, they were non-disastrous. Top line S&P 11%, bottom line 3%. Noble's index Top line 17, bottom line 26. They are delivering margin expansion in an inflationary environment because they got pricing power. That's a big 1-2 punch, and that's why they've attracted a lot of assets.
Yeah, and I keep explaining this. Like, people say, the S&P has a less than 2% dividend yield. Who cares? I said, let me tell you something. Historically, there is a big difference between a company that has a 1.5% dividend yield and a 2.5%. Over many, many years. Bogle used to do this in his books, say this is 1.5% difference in a return over 30 years. When you start getting into hundreds of thousands of dollars, you get into the beauty of compounded interest, which is the greatest invention in the history of the world, which is that in the early days, it doesn't look like anything. And then when you get older, all of a sudden you're 65 or 70 years old, and that difference is enormous. And it's very, this is a simple way I explain it to people. The other is people say, give us the highest dividends. You know, I want to buy the top, 5 dividend. I said, those are not safe. A company that's paying you 9% dividend yield right now is probably in a somewhat precarious position. You better be real careful.
And even if it's 5 and it doesn't grow, you know what it is? It's a fixed coupon bond, totally exposed to inflation and any residual increase in rising rates we might see.
Yeah, it's a good point. I know we've wandered around a little bit here today, but we've got two experts on big topics. So that's why we have the best people here from the ETF business, folks.